Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, February 24th, 2022. This one I'm looking forward to doing. I was almost started to get one out later in the session, and I realized by the time I got everything in that I wanted to, got that video uploaded to YouTube, it wasn't going to get out to you before the close. So I figured wait to see how we close today, and now that we see where everything's at. Like I said, lot to cover. Well, not too much. It won't be too long. But here's how I'm going to do this. I'll tell you how I'm going to walk through this video in case you want to skip ahead to a part. But we're going to look at the charts of the stock futures and ETFs. We'll look at them on just a couple time frames. And I'll hit on a few sectors as well, because I always say the market is simply a sum of its part, and maybe with that a couple key stocks. So in what we're looking at here are important levels. Want to talk about a little bit about the VIX, how that plays in. And then finally, I'll give my thoughts on the move today. That's, I think, important. The scope of the reversal. I've been doing this a long time, and I've seen a lot out there. So I do want to make a comment. It was an impressive reversal from lows to highs today, and I have some thoughts and things to share with you there. So that'll be towards. We'll keep that towards the end of the video. All right. So we're going to start out here on the weekly time frame, and I'm doing that. I'm going to loop back and forth. If you recall, throughout this correction, this is where it all started. I was, going back into really all the way back in early November. Had a setup here, and wow, I got to really zoom that in a little bit. It's hard. Let's do it this way. Let's go back here, and let me grab this zoom in tool. There it is. And so that's what we're looking at back in early November. Sell signal number 1, we had a sell signal 2, and so if you recall back then, assuming you were trading at the time, that I laid out targets T1, T2 through T5, and all of which were hit. But as we started to get going, and this is something I've been doing for a couple of years now, we had, I'll start out with usually the short term. This is my go-to swing trading time frame. But because of what has been or what was developing on the longer term charts, as we got down here, somewhere in there, I started to lay out and cover the weekly chart of QQQ, and told you I was going to shift my focus as well as the evidence built, and as we hit these targets, I was going to turn my focus to the longer term targets. And so that is that's unique. All along the last couple of years, we really just stuck with any pullbacks, even the divergent lows, because we were in a bullish uptrend. The main focus was on the 60-minute charts, the time entries and exits, and get your little 6, 8, 10%, 12% pullbacks along the way, and then look for divergent lows to go long. So again, just to reiterate, my focus has turned to and remains on the weekly charts, because right now, and I'm speaking to trend trader and longer term swing trader, I'm playing the long game. Not meaning not position long, but going for the big prize, which are these additional targets. So with that being said, when you are trading a time frame, a longer term time frame such as a weekly, all that matters is how you close the weekly chart, and you can also look at those levels. So let's start out here. So this was T1 back here, which was hit on that initial leg down, and it was a very good support level at the time, good enough to make it the first weekly target. Technicals played out beautiful. We hit it. We bounced back up, stopped where we should have stopped as far as Fibonacci retracements, the 200-day moving averages, which on this chart are the 40-week moving averages. Capped that advance, started moving down, broke down from the bear flag, and that's where we're at. So far, it's been nothing but red sticks. Despite today's reversal, we are still negative for the week, and so that's what you want to see. Again, if the bear flag is going to play out. So far, it triggered, and it's been playing out, and so I'll be very interested to see how we close tomorrow. Look, you could print a big green, a green candle that could turn slightly green, just has to take out last week's closing low, and still play out to be a bear flag. See, here's a good example. The flagpole had one green candle right there, right? But it was still a pretty impulsive leg down. So I just wanted to say that's not going to change anything if we happen to close green tomorrow. All the better if we dump down because you want to see impulsive selling coming out of a flag. And most importantly, again, it's a weekly chart. Most importantly, ideally, you want to stay below that former support, now resistance level. That's TA 101. Support once broken becomes resistance. Does it eliminate the bearish case? No. As I talked about, they're just little check marks. I play the game of little micro, day to day, even minute by minute, sometime calls, with check marks for bullish or bearish case. Look, we're well below the 40 weeks, and the fact that we already tested them. And now they acted as resistance on the back test with a rejection, and so there is absolutely zero bullish in this chart or what happened today. Today was just, again, I'll speak more to the scope of the reversal towards the end of the video. I just wanted to say, look, I pointed out an objective shorting up today on the backfill of gap, and that was just based on the short term. That was a 1 minute chart I showed you. But this is even better because you're back to a much larger resistance. The gap was just, again, 1 minute chart, short term thing. And so this is where we're at right now. And again, we'll see, if we start to take out that level, especially on a solid weekly closing basis, and we start to get a few green candles and no longer have a pretty symmetrical flat move down that equals or approximates the flagpole. And then, of course, you take out the 40 weeks, and yeah, that's going to start to change things. This is still monstrous resistance right there. So I guess the takeaway is there's a lot of work to be done on the upside. It's possible, and remember, I speak in probabilities, but I still think the probability, the odds at this point in time still significantly higher that we're going to go down to that 300-ish area on QQQ before the market goes up to new highs. That is at this point in time, I believe, and that starts to gradually change based on those things if they happen. All right. Next up, the S&P 500, of course, more broad-based measure of the stock market or the economy, and we're on a weekly chart. All the trend lines have been broken that I had, and turn off all these trend lines real quick here, and just show you simply that we've moved down in an impulsive leg down off the highs. Sell signals triggered there as well. Had a nice a textbook looking bear flag continuation pattern, and nothing but red sticks so far, even with today's rally. Again, so tomorrow, just all the better that we have a red candle again, but as I just showed you a minute ago in QQQ, it's not absolutely necessary, but it would help to see a down day tomorrow, because a down day tomorrow would certainly guarantee that this candle stays red and also stay down below the 40-week moving averages. So again, that's the mode I'm speaking to right now, the very the typical swing trader or trend trader, and as of today nothing's changed despite the impressive reversal that we had intraday. And then on IWM, same thing, nothing's changed there. Sell signal, major sell signal when that year-long trading range was broken. Textbook looking bear flag as well, still red candles coming out of there. And that's so far with IWM, it was about a perfect test of the recent low. So there's one index that hasn't yet taken that out. So we're going to get that in a second too, and show you which indexes or sectors, I should say, have taken out the recent lows or broken support, and which ones caught support today. There were quite a few things that did hit support. So the bounce was technically justified. There were support levels I saw. I didn't expect to see such a large reaction off those levels. And again, I'll speak to the scope of the move later in the video here. But that's still my target. And like everything else, this is the big level right there, 209.23. Plus you have the 200-day or 40-week moving averages up there. So this is still in a clearly in a downtrend. As all the indexes are right now, near-term downtrend, and nothing there has changed. Okay, next up we're going to look at shorter-term charts again, daily and 60-minute charts, and something that I've mentioned for years when we're in a solid correction like we are now, downtrend, what I look for and like to see, and it's not an absolute necessity, but it certainly helps. are divergences across the board on if most and if all of them, great, all of the indexes or at least most of the indexes. And I like to see it on the 60-minute charts, and I like to see it again, not always, but if you can get it, great, on both the futures and the ETFs. So I'm going to go through that real quick. We do not have divergence, at least most certainly not there. In fact, we made a slightly lower low there, which really took it out on ES. So you had the potential for divergence at that recent low or any marginal new low, but you see we took it out. So I just wanted to say on the 60-minute chart of ES, no divergence. Let me just look at the like this 2-hour chart too. You can see there close, but really technically no. Again, close enough if you want to say you have nearly an equal low. Then if you go out to this 2-hour time frame, you have it, and you do have it on the daily, and that makes sense because as I'm walking out now longer in time, you go from 60-minute candles to 2-hour candles. Well, you're getting closer to a daily chart. A daily candle is 6.5 hours, or 6.5 hours in a trading day. All right, so next up, let's look at NQ. And we're on a 3-month. So you do have this right here. Again, only RSI divergence and not the cleanest divergence, and the PPO divergence was clearly taken out on the 60-minute chart there. A couple downtrend lines that may come into play right here. If you're looking at the 60-minute chart. And so that needs to be either modified to say RSI divergence or just taken out completely. I'm going to just move that away and let me look at the 2-hour candles for you, 6 months. And you can see again, this is NQ, a slightly lower low. So technically speaking, if you want to get technical, that divergence was slightly undercut. And again, I'm on a 2-hour chart now. We don't have it on the PPO on the 60-minute chart, but there's some RSI divergence there. So again, and I've been warning of these divergences now for about the last week or so, that they are in existence. You have to respect them because that is quite often what can mark a bottom of a correction. So they're in play. And I'm going to get to the daily charts here in just a second. We'll look at the ETFs, but before I do that, for you futures traders, let's look at RTY, small cap ETF. And so there's RTY, but no divergence. You have a lower low, but guess what? You don't have a higher low in the indicators. You have lower lows right there, even there. So no divergence at all on the 60-minute chart of RTY. And just go out here to 2-hour, stay consistent, and not even there. Really took out, again, maybe if you want to stretch some RSI divergence right there with roughly an equal low. There's a downtrend line as well that does likely come into play, but again, the big level's up here. So this is just noise. I'm going to talk about that at the end of the video. And when you go down, when you are trading on, if you're primarily to manage the positions that you have, again, talking about long-term trend positions, if those other targets going to get hit, and you're focused on the daily and more so the weekly charts, and you have volatility expand, which always happens during a correction. Corrections, stocks tend to fall a lot faster than they rise. That's when the VIX goes up. Here's the VIX moving up. And so what we saw today is simply a function of that volatility, that big intraday reversal with the futures down big in the morning, the market's gapping way down and then being bought up. And I talked about it earlier. It's par for the course. And so you have to expect it. And so what I do, I'll look at these short-term charts because you know what? Each little rally, each little resistance level, although in itself doesn't change the entire picture, one after another does. You know, just like what's that expression? Every journey begins with the first step. Well, every rally or move to new highs begins with the first break of resistance, the first trend line breakout, and things like that. And then it adds on from there. That's why I have those check marks. So I just wanted to say that the reversal today is you know, the move is completely in line with what I've seen in previous corrections. Even those that you know, sometimes that's what the start of the end of a correction looks like, what we saw today. And quite often it is you see 5-6% intraday reversals when volatility is really high, and the next day or the following couple days, the market's a lot lower. So that's it. So I guess my takeaway, especially to the newbies, those of you that are not used to trading in a volatile environment like this, is don't read too much into a single day reversal. One day does not make a trend, is what I often say. And by the way, that was just the weekly chart of the VIX. Here's the spot VIX on the daily. It's funny. This is the targets that I've laid out in recent videos over the past couple weeks or months. All these targets here, and look where we hit today. My 37.61 target, almost to the button. 37.79 was the high. We also hit it there. It was that previous. So that is a big resistance level. You can see the VIX. Boom, 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 boom. If it can break out. And if we're going where I think we're going to go, we're going to break out and head on higher. And I gave you VXX recently as a trade idea. We already hit T2 once, almost hit it today again, came close. And again, if we have another leg down, we'll almost certainly head up and hit the next couple, at least the next couple targets, T3, T4, and so on. These are rough targets. You want to align them. I always say this: if you're trading the VIX, align it with the stock market. What I mean by that, well, I'll tell you exactly what I mean by that. If QQQ happens to hit anytime soon, T2 down around 300 to 299, and let's say at the same time you have IWM hitting the 171 target, and you have SPY coming down, any or all of these, but the more the better, also coming down to that 394.50 target. That's where, again, unless I see something I don't like, I'll be reversing from short to long, and I'll also be selling my closing out on any VIX long positions, regardless of whether they're at any of those targets. So those are just kind of rough targets. VXX is full of decay. They roll futures. It's not going to track the VIX index perfectly. Nothing does. So I just wanted to kind of mention that. Use the indexes as your guides. If you think the index is going to bounce, then you can just infer that the VIX is going to pull back, and vice versa. Okay, quick look at the daily charts, because that's, those are important. So far I've been jumping back and forth between the weekly and 60-minute charts. This again was a level. It was a support level marked in advance here, and we hit it to the pretty much to the button today. That's 411.13. Created that line all the way back in May of 2021, and it's a good support right here and here and here. All these lines, we hit it right there today to the button on the gap down, and that's where the buyer stepped in. So it wasn't a completely random reversal. I think there was a little bit more to it, to the cause of the jump. But either way, we still have that potential, but still unconfirmed divergence. So again, I would be remiss not to point this out. Told you where I think we're going, but if anything was guaranteed, it would be easy, and it's not always easy. So you still have a downtrend line there in the SPY. You have big, that's why it was color-coded yellow, big resistance about 424.50 right there, and that's exactly where we rallied to. So just like on the weekly chart, we rallied right up to resistance here on the daily as well. But I did want to mention, I'm going to watch this. So continue to build on these gains, and let's say make another run back at the 200. We could get this PPO turning back up and have confirmed divergence. But what tends to happen, if I'm going to be right on my targets, this divergence will be burned through soon. And at that point, that's when we'll probably be getting closer. We'll probably already be at those targets if that happens, but we'll see. All right, QQQ, also positive divergence potential. Again, I call it potential divergence. PPO is starting to curl up a little bit, but it has not made a bullish cross, but you have that divergence there. And then on IWM, you also have potential divergence. You made an equal low. You can either make a lower low in price if your indicators are making higher lows, or you can make equal lows as long as the indicators are making higher lows. And again, potential divergence, you look at the PPO, it's really still moving down. All right, so that's that. Let me move forward here with the indexes. Maybe we'll cover them all. There's only 11. And when I say the indexes, I'm referring to the 11 sectors in the S&P 500. Here's tech, the big one, by far the biggest sector in both the S&P 500 and NASDAQ 100. That was a big level right there, 146.86 roughly. You can see it was support for a while. after the breakout of that previous high support. We went below it and we recovered it today. So you have to respect that. That was a whipsaw, aka could be aka bear trap, whatever you want to call it. When you drop down below a support level and recover it by the end of the day, and that one did. We made a solid recovery. Yeah, I don't know. I was going to turn off the post-market trades, but we haven't moved much. I'm looking at another screen. We're about where we closed. So that's something to note. And again, potential divergence. So this could be a bullish setup. You know, if we go on to break out. If you look at it as a wedge, well, I think at best case the wedge would have to form a little more. Maybe, you know, put in a second divergent low, something like that. But again, it's something I'll be watching. And you can probably draw a little downtrend line there, but that would show better on the 60-minute chart. I just wanted to say that, you know, I'm going to just give checks for bulls or bears. I'll say the bulls get that one because you had a fake out, false breakdown in XLK. Followed by a recovery, a solid recovery back above support. So that's if you want to play the who won today game in the tech sector. XLV, big support. Now it tested it perfectly right there, 124.76-ish. That's that trading range. A lot of just like the stock market, a lot of sectors look very toppy. Been in trading ranges. They had false breakouts to many of them, just like the small caps and just about everything, and that failed. But that was a trading range there. We broke to all-time highs, and we back tested it on several occasions there, and again today. So I'm going to give this one today again check mark to the bulls because they made another successful defense of a key support level. However, if it gets broken, especially on a solid daily close, bears get a check mark. So these are the things you want to watch for, and it's easy. You can just set a price alert above today's low. I'll set it above, you know, that level there, and these are the things I'll be looking for. So XLV, healthcare, it's second largest sector, I believe, in the S&P 500, about 16% or so. Financials, another one, parked right on what I believe, and that's why I had this line color-coded yellow for a while, $37. You had a breakout there, you failed it, then you set up in that trading range, boom, 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 broke it, successful back test, one little whipsaw, but a lot of reactions on that level, a lot of them, and another one today. So, yeah, you can give a check mark for the bulls, but look, not too much. It also took out, you can see what's happened, and there's a lot of cross currents, if you will. You took out the 200-day simple right there on the gap down today and the 200-day exponential in one fell swoop. And so you hit support. And again, I would be surprised if they didn't come in and at least buy a little bit here. I didn't expect this big of a bounce, but it's nothing huge. So this is ping pong between support and resistance. We gapped down to support, good support, and we bounced up to resistance. And obviously, you know, near term, it's going to help if the bulls could take out the 200 exponential and then the 200 simple, and then you have resistance up there. Whereas the bears are going to get a nice fat check mark. So let me keep it simple, guys. I know I'm talking about a lot of levels. Just look for a break at today's lows. Just look for it in the indexes. Look for it in some of these sectors I'm telling you. These are key sectors. And if you get that, that's where I believe the market will crater. I'll be very blunt. That's where I think all the longs that bought today, and I had little doubt it squeezed out a lot of short interest, which is a good thing if we are going lower, because that will set the stage for that quick drop. When you have when short interest starts to ramp up in the market or security, you have those shorts that tend to cover on the way down, take profits, and it makes it harder to get to where you're going, at least fast. But when if we got a lot of shorts blown out today, again, assuming that we can take out today's lows, it should be a pretty swift ride down to the next support levels there. And there's still, from way back when, I'm still maintaining these second and third targets. We hit T1 back here, made a marginal new high from the breakdown, the short entry, and this trade is still intact. I still think those targets will be hit. But we need to take out that $37 level. Communication sector, again, it's a common theme. This is not random. We had so many things hit support today. This support is it's $64.95. We'll call that $65. It was previous all-time high there. checked again, all-time high, finally broke out, back tested, went sideways for about a month and a half. So then it acted as support, and we just hit it for the first time in a long time. So that's a reflexive bounce. But based on what I'm seeing in the charts, again, this is just my interpretation. This is not the end of this correction. This is just a bounce off support. How high does it go? Hard to say. I'd have to maybe reduce some of these lines to give you resistance levels. But that's just my thought, is that there's probably more downside to come. Even though that is, you got to give it credit. That's a bullish engulfing candle, by the way. But so we'll see. We'll see what happens over the next few days. XLY, gosh, I mean, these are all these things just hitting support. You had good support right here, 161.51. Hit that support bounce, but look, big resistance. So I think this is just a function of the volatility in the market. A lot of these indexes and sectors and key stocks hit support, but I cannot be completely dismissive of it. I'm seeing too many sectors, too many stocks with positive divergence, and that's could be the potential for or the catalyst for a rally to much higher levels. And look, you can even still keep the long-term bearish case intact. We're in the downtrend, right? This is XLY, consumer discretionary. You could come all the way back up here. You could even back test this trend line, and then you still have a series of lower lows and lower highs, right? So just wanted to say these are levels to watch. Industrials, well, here's another one. Industrials just yesterday broke down that see, this is it. This is what I'm seeing, guys. I'm seeing one sector and one stock after another. It's a slow roll, but it looks like a market top to me, and that's again what I maintain and have for a while. This whole multi-month or multi-month, it's a year-long plus sideways trading range with two failed breakout attempts to the highs just reminds me so much. It's nearly identical to what we saw in IWM. A false breakout, sideways trading range, breakdown back test. It's what we saw in Netflix. There's our trading range, and many other companies and sectors. But they're breaking one by one. But that's the trend, the current trend. We're seeing market leading and big name stocks break down one by one here and there, as well as certain sectors. And we just have a few more that really need to go, such as Apple and some of the other bigger names that haven't completely broken down yet. And here's XLP. I won't go over. We'll stop here because as you go down the line, the weightings get smaller. It's still a significant portion of the S&P 500, but it's about 8% weighting. And you can see a nice clean trend line here. I'll show you that on another board. These too many levels, but we kissed it today perfectly. Here, let me just show another board. So first of all, you have what I always harp on. There's your big 200-day moving averages. I have the simple and the exponential in red and blue. And just they do a great job of acting as support during a bullish trend and resistance when you're in a bearish trend. So we know the markets already took those levels out. So by that logic, it makes sense that we're going to see XLP finally give way too. It's one of the last holdouts. By the way, these are staples. So it should be stronger. This is what happens as the economy transitions from a growth environment into a slowing or recessionary environment. You're going to see money moving out of growth stocks, aka technology, into defensive issues like consumer staples and utilities and things like that. But they're not prone to a correction. They will go down with the market. They just tend to fall less. And when you take those levels out, that's usually that is bearish. And then again, the lines they are act as support on the way up, and then they're resistance during a bear trend. And when you recover them, great, you're back into a bull trend. You know. Simple but effective. And so we hit it today, and that's the bottom line, the takeaway from this video. Why I'm spending so much time covering so many different sectors in the indexes. Quite a few things hit support. You know, I knew those levels were there. I thought they would go through without so much of a bounce, this big of a bounce. But again, it does not surprise me in the least. And to keep it simple, again, the takeaway going forward is watch them, and it's a common theme. Today's lows. Just about everything I've highlighted hit either a price support level, trend line, or key moving averages today. And so if today's lows get smashed through, that is, I think, going to be, you're going to see a ton of stops on long side traders. Because if I bought today, if I reversed my portfolio from short to long, I would have tight stops, relatively, not right under, but not too far below there. And then again, lots of resistance, gaps, everything overhead, downtrend lines, and everything else. Okay, I just wanted to mention I'm not going to spend time analyzing gold and silver. I just want to say that nothing's changed. They got faded today. Their rallies got faded to a good extent, but not that much. Gold was down a little fractionally, gave up some of the gains, but again, the breakout's still very much intact. So, as what I said earlier today, I believe that gold and silver still should be in buy the dip mode right now because of the recent breakouts. So I don't want to spend much more time on those. Finally, I'll talk about what happened today and that whole noise thing I was talking about earlier. Okay, again, I've been doing this a long time, and I've made mention before, but I don't blame every rally like some traders do, especially if they're bearish and short on the PPT, the plunge protection team. But it is a thing, and I encourage you just go here and read. I'm not going to read the whole thing. You can go to Wikipedia, you can go to Investopedia here, and they talk about it was created after the crash in '87, Black Monday. And the bottom line is, it is a thing, but unlike the Fed, who's more transparent, not 100%, but pretty transparent on what they're doing, what their balance sheet is, this it's completely a private entity, a private entity, if you want to call it that, and they report directly to the president. And I have personally, I would put very good if I could place a bet with someone and have that document, I would put a very good bet on the fact that Biden, look, I don't want to again ruffle anybody's feathers here politically, but we all know his ratings in the absolute gutter have been before this Russia thing even started. His foreign policy has been just abysmal. The withdrawal from Afghanistan. We all, even Bloomberg, a Democrat, ran on the Democratic ticket for president, came out and said that the Dems are going to get clocked at the midterms. Just what's going on with inflation, the economy, Russia, everything. And so I have very little doubt that, or I wouldn't put it beyond Biden if he called up, got on the phone, and the theory is, the big banks that it's a revolving door with the Fed. Whatever means that they have, there is a lot of evidence out there that shows that they will manipulate stock futures. So what I'm getting at today, we hit some levels, support levels, as I just spent a lot of time talking about. But the scope and the magnitude of the bounce, especially, I've seen bottoms before, and this does not look like a bottom to me. It doesn't look like the end of this correction based on a lot of things. And the way they bought up those futures with the news, usually there's at least an abatement of the bad news or outright good news that happens. Well, after the invasion last night, Russia, outright invading and attacking Ukraine, and I was poring over the headlines today, the only takeaway, and what I already assumed, is that based on what's going on now over in Europe, with Russia and Ukraine, is that in the Wall Street Journal confirmed this today. It knocked down the probability of that 50 point rate hike, which had just recently gone up. So the only positive fundamental thing that happened today remotely was the fact that we probably now it tilted the at least the odds to a 25 point basis point rate hike, which then helps a little bit to go support growth stocks. Growth stocks get hurt the worst on a rising rate environment. And other than that, you can't spin anything. If you can find some good news out there, let me know. But again, I always say it's not always about the news, and charts are the charts. So we bounce off support, and that's it. But you can read about this, and again, I would put good money that the White House was on the phone, knowing what's happening, saw futures, and planning this. Russia this didn't just come out of nowhere. And when they see the markets collapsing like this, I'm sure whatever is in their power, and it's not just a Biden administration thing. It's been government gone wild for years, and it's been really, really crazy since COVID hit. the amount of overstimulation and overreaction to everything going on. So again, that's my thoughts. Maybe I'm wrong. Just wanted to point that out. And now finally, I will wrap it up with a comparison. Okay, so I'm telling you that I've seen similar rallies and it's par for the course, but let's look at that real quick. Okay, here's my little pop-up box on the left. Will come up here and I'll measure. It's about a 7% turnaround in the index, at least in QQQ, not as much in SPY. QQQ is higher beta. So that's what happened today. So let's just roll back in time and we'll just look real quick and then we'll wrap the video up of what, some similar drops in the market when we've been in correction mode. First one that at least up to this point that's comparable is COVID, when COVID hit. So when you want to compare, remember we were falling. Today was a new multi-month low. We took out support, we went down. And so the closest thing when you look, what I'm trying to look at for comparison is a green candle. My candles are set to show the net close for the day, whether, as long as if a candle close above the previous close, then that's going to be a green candle. If it closes below, it's a red candle. And so when you see a green candle like this is just candlestick analysis 101. It tells you the fat part, the body, it shows the open and close, and then down below you can't see it. There's a little tiny tail on that one. It kissed the 200-day moving average, but we'll measure it. And that was, again, in a comparable type correction at that point. And so from the morning, the low part of that candle, that was a 5% turnaround. Right here, you see a big, powerful candle that went down. The next day, here was a green candle, so we were dropping, and then that morning we were down here. By the end of the high point of the day, we were all the way up there, 9% turnaround. Again, you'll see them, and with more downside to come is my point. They didn't mark bottoms. And again, my takeaway, as I told you before, when the volatility is high, the VIX is high, there's a 9%, almost 9% turnaround, and there was still more downside to come. So again, it's just the nature of the beast. And so let me show you a couple more, and then we'll wrap up here. Here's let's go back to there. We'll go fourth quarter of 2018. It's a big one. That was the previous biggest one right there. And I'm looking for them here. I hadn't done this ahead of time. Just knew we'd find some in there. You know what? Right before that, I recall there was some activity right here. There it is. There's one right there. There's a big correction from high to low back in 2018 that was a drop of about 12%. And you can see we gapped down that morning or went down all the way from the previous close down here, and the intraday reversal was about 5% there. So again, they're not. It's not unusual to see that. And as I said in the beginning of the video, you need to define your trading style. It could be the start of or the end of the correction and the beginning of a rally that's going to take the market to new highs. Again, it's just to say otherwise with certainty, you're just not credible, because anything's possible. Nobody knows. But I just want to say it's in the realm of being perfectly normal when volatility is as high as it is. And the key to it is you can use and look at the short-term charts, but you need to kind of tune that out if you are trading off this weekly chart and you're targeting longer term targets. Then anything less, especially down on the 60-minute charts and the 15-minute charts, it's noise. And if you're a boater, especially in coastal regions, maybe the Great Lakes, or even a trucker or an old school person that used to play with CB radios, there's a knob on those the VHF radios and the boats and the CB radios. It's called a squelch knob. And what it does, it attenuates the noise. If you get on a channel and there's a lot of static and distant communications going on, you turn the squelch up and it will attenuate the noise. And that's what I have to do in a high volatility environment to keep my eye on the ball for the longer term trades. And that means not putting too much stock into what happens here on these shorter term charts. Again, if my trading plan is to trade off of here, which at this point in time it is, at least that's what I'm speaking to. And sometimes I'll come in and show you quick trade ideas, or things I'm doing on the 5-minute charts, intraday balances, things like that. But that's not what this video is about. All right, guys, I'm going to wrap it up here. And like I said, I'll be eager to see what tomorrow brings, because it'll be the close of the week. And it will probably almost certainly not give us anything definitively unless we have a real bad day tomorrow somehow and we can come down here and take out today's lows. Then I think it would be almost a foregone conclusion, or very, very high odds that we'll either hit that second target, who knows, possibly tomorrow, but most likely next week. We'll see. And if not, if we start going up, I'll do the same thing I do now. I'll tell you day by day and level by level where, hey, that's bullish, that's bullish, that's bullish. Maybe start scaling out of those long-term short positions. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.